IMF raised their global growth forecast slightly higher by 0.2 percentage points to 3.0 from 2025 and by 0.1 percentage points to 3.1% for 2026, given what was seen as stronger than expected consumer activity ahead of an August 1 jump in US tariffs and a drop in the effective US tariff rate to 17.3% from 24.4%. IMF, the International Monetary Fund, they also say the global economy faces ongoing major risks, including a potential rebound in tariff rates, geopolitical tensions, and larger fiscal deficits that could drive up interest rates and tighten global financial conditions.
Following an unprecedented escalation in tariffs imposed on the rest of the world in April, the United States partly reversed course, pausing the higher tariffs for most of its trading partners. This and the de-escalation of trade tensions with China in May modestly reduced the US effective tariff rate from 24% to about 17%. Despite these welcome developments, tariffs remain historically high and global policy remains highly uncertain. This modest decline in trade tensions, however fragile, has contributed to the resilience of the global economy so far. A few other developments have also helped. First, concerns about future tariffs led to a strong surge in exports to the US in the first quarter of the year. This front-loading helped support activity in Europe and Asia. Second, financial conditions improved and monetary conditions eased as global inflation continues to recede, largely unchanged from our previous projections. Third, the dollar has depreciated by roughly 8% since January. As we already pointed out in April, the effect of tariffs on exchange rates can be complex. In previous episodes, the tariffing country saw its currency appreciate, buffering the impact of the tariffs. This time around, however, the dollar depreciation has amplified the impact of the tariff shock on other countries' competitiveness. With a stable value relative to the US dollar, the Chinese RMB has tracked the dollar, while the euro has appreciated significantly. Accordingly, we have revised our growth projections upwards from the April 2025 reference forecast from 2.8% to 3% this year, and from 3% to 3.1% next year. Most regions are experiencing modest growth upgrades this year and next. This resilience is welcome, but it is also tenuous. While the trade shock could turn out to be less severe than initially feared, it is still sizable, and evidence is mounting that it is hurting the global economy. For instance, compared to our pre-April 2nd forecast, global growth is revised downwards by 0.2 percentage point this year. And at around 3%, global growth remains disappointingly below pre-COVID average. And we continue to project a persistent decline in global trade as a share of output, despite the recent front-loading, from 57% in 2024 to 53% in 2030. Risks to the scenario remain firmly to the downside. The current trade environment remains precarious. Tariffs could well reset at much higher levels once the pause expires on August 1st, or if existing deals unravel. If this were the case, model-based simulations suggest global output could be 0.3% lower in 2026. Without comprehensive agreements, the ongoing trade uncertainty could increasingly weigh on investment and activity. Further, while exports front-loading has supported global activity so far, firms could become vulnerable if the demand for stockpiled goods does not materialize. The geopolitical environment also remains fragile, with the potential for more negative supply disruption. While global inflation continues to decline, the latest price data suggests that inflation pressures are building gradually in the US. Overall, US import prices in dollars have remained largely unchanged or even increased this year, suggesting that the cost of tariffs will be borne by US retailers and importers, and eventually customers, as firms start to pass through higher costs into their price. In too many countries, the combination of high public debt and still elevated public deficits continues to be a cause for concern. The lack of fiscal space makes these countries especially vulnerable to a sudden tightening in financial conditions that increase term premium. Such tightening becomes even more likely if central bank independence, a cornerstone of macroeconomic, monetary, and financial stability, is undermined. Turning to policies, our recommendations continue to call for prudence and the need for improved collaboration. Let me outline some key priorities. First and foremost, restoring stability in trade policy is essential to reduce policy uncertainty. We urge all parties to settle trade disputes and agree on clear and predictable frameworks. Collective efforts should be made to restore and improve the global trading system. The need for predictable and stable rules extend to other areas of policymaking. It is important to reaffirm and preserve the principle of central bank independence. The evidence is overwhelming that independent central banks, with a narrow mandate to pursue price and economic stability, are essential to anchoring inflation expectations. That central banks around the world achieved a successful soft landing despite the recent surge in inflation owes a great deal to their independence and hard-earned credibility. Restoring fiscal space remains a priority for many countries. Even where new spending needs are emerging, efforts must be made to implement gradual and credible consolidation while protecting growth. Lastly, as global growth remains tepid, more efforts must be made to increase long-term productivity through structural reforms.
Hello, welcome back to Global Business Insights, where we consider the headlines moving markets. First, let's dive deeper into Pierre Olivier's remarks from the IMF press conference on the global economic outlook. Pierre-Olivier Gourinchas, chief economist at the International Monetary Fund, said the world economy is still hurting despite tariffs being a bit lower than expected. Global growth remains lower than the pre-pandemic historical average of 3.7%. Global headline inflation is also expected to fall to 4.2% in 2024 and 3.6% in 2026, adding that inflation would likely remain above target in the United States as tariffs pass through to U.S. consumers in the second half of the year. Recommended policies to bring confidence and sustainability by calming tensions included the usual, that is, preserving price and financial stability, restoring fiscal buffers, independence of central banks, and implementing pro-growth reforms. The U.S. economy is expected to expand at a rate of 1.9% in 2025, 0.1 percentage points higher than the previous forecast, as tariff rates settled lower than was announced in April. The IMF also see the big beautiful bill passed could raise output by about 0.5% on average through 2030, but with U.S. fiscal deficits projected to be larger by about 1.5% points of GDP in 2026. The IMF latest forecast yesterday showed that the euro area GDP growth will inch up by 0.2 percentage points to 1.0%. That's GDP growth in 2025. Revised heavier defense spending commitments will also have an impact in later years. In 2025, UK growth is at 1.2%, Germany 0.1%, France 0.6%. In China, growth in 2025 saw an upward revision by 0.8% to 4.8%, with GDP Q1 outturn implying a strong upgrade from earlier projections. Growth in sub-Saharan Africa, the economy is unchanged at 4% in 2025. South Africa GDP growth was unchanged at 1%. Notably, Nigeria's GDP 2025 forecast was upgraded by 0.4% to 3.4% before dropping to 3.2% in 2026, a reflection of a slightly higher rebased economy, higher crude oil production, and improved macroeconomic stability for future growth. On Nigeria, senior economist Tilewa Adebayo, CEO CFG Advisory, in his latest note on 2025 half-year economic update on Nigeria, commented on the need to transition successfully from only economic stability to achieving robust, sustainable growth. He also observed growing concerns that the government's focus is shifting from economic reform to re-election and political considerations. Analysts recognize major improvements in macroeconomic stabilization, but still have said Nigeria will see little gains that impact the larger population, except it can significantly transform productivity, upgrading electric power generation, supply and distribution, reskilling youth, expanding technology infrastructure, curbing crippling debt expansion by rethinking its balance sheet, and seriously addressing the welfare of common people in a more impactful social safety net program. An array of talks, seminars, pronouncements, and slogans like Nigeria First should not be mistaken for progress, which requires a lot of institutional rework at the micro level. And indeed, there's a huge need of digital innovation, executing productivity enhancing process reengineering at the trenches, at local, state, and federal levels, and especially with important institutions. These actions are hard work and do not make headlines but deliver impactful change. The attention given to the electric power sector is definitely inadequate given the impact of power supply for growth in a more technology-oriented global environment that is much more competitive than, say, 5 years ago. Let me make a point on the IMF Outlook update. IMF updates on Outlook events can be somewhat strangely similar. IMF excels in consistently showing the way, but what struggling countries need more is support to lead the way, which implies a vastly different dynamic. Leading the way is more about how than about what, and also depends very much on the specific country context. Therein lies the complexity in moving with IMF advisory, which evades, I would say, leadership and execution issues such as urgency, ownership, building trust capital, and providing enablement to absorb the impact of change. All can still agree with the IMF that the resilience we see all over the world remains tenuous and uncertainty is not abating, implying policy architects should be prepared for anything. Now to other business stories. S&P closed lower yesterday, S&P 500, as progress on trade talks with China yielded little and traders braced for the Federal Reserve's rate decision. Microsoft and Meta will report results today, followed by Apple and Amazon tomorrow, as the Nasdaq looked like it was pulling back a bit. And we also get US ADP, private sector employment report, and the Q2 US GDP growth data, plus latest US Energy Information Administration's weekly report on crude oil stockpiles. Union Pacific, the largest freight railway firm in Western America, is buying Norfolk Southern, which runs tracks in the east, for $85 billion. This creates America's first coast-to-coast railway operator and would be the sector's biggest ever merger. There are reports of widespread dissatisfaction in Europe over the latest EU-US trade deal signed in Scotland, perceived as too one-sided in favor of Washington, also seen as reflecting erosion of European competitiveness. Now, France wants champagne and other wines and spirits also exempted from US tariffs, amid some confusion in Brussels and Paris over which products will be excluded from the new 15% tariff applying to most European goods imported by the US. Germany's retail sales rose 1% month-on-month in June after a revised 0.6% decline in May, better than a forecast of 0.5%. Also just in, the German economy contracted by 0.1% over the quarter in Q2 2025, following a 0.4% increase in the first quarter. However, the Eurozone economy grew a better than expected 0.1% in Q2. Asia Pacific markets closed mixed as the US-China talks in Sweden ended without a tariff truce extension, which still needs Trump sign-off. Well, that's it on this special edition of Global Business Insights. This is Bode Oshosami. Bye-bye.